Hey everyone, fintech here. So I made a mistake in my last video covering SoFi where I went over what I thought were pretty good earnings for the company, where they reported a beat and a raise in their guidance. But I didn't talk about a big issue that a lot of people started calling out in the comments, which is SoFi potentially undergoing a reverse stock split. Now I know I'm super late to this, the club and StockGoat both already made videos on this, but I don't think that either video hit on all the important points connected to this reverse stock split. So in this quick video, I'm going to cover everything you need to know before SoFi takes a vote on July 12th, 2022 to decide this issue. Going over what a reverse stock split is, what impact this will have on SoFi in the short term and the long term, and the question of, is SoFi's CEO, Anthony Noto, intentionally doing this to make himself money at the expense of us shareholders like all these comments suggest? So let's start out by answering what even is a reverse stock split. After all, it sounds like some kind of gymnastics move. So you may have heard when Tesla underwent a stock split in August 2020, where every existing shareholder was given 5 new shares for every existing share that they had, with each share worth 1/5 the price. So the total value for each shareholder was the same, it just lowered the price of buying a single share in Tesla, which is helpful for small retail investors who couldn't afford to buy a single $1,500 share. Clearly they didn't use SoFi Invest, which lets you buy a fraction of a share, link in the description for $5 when you sign up. After their split, Tesla's value as a company absolutely exploded, going up 12% in a day and doubling over the next few months. The combination of publicity, timing, and more access to investors hugely pumped up SoFi's stock price in the short term. So what now is going to happen if SoFi undergoes a reverse stock split? Well, a reverse stock split does the opposite of a stock split. For every 2 shares that someone holds now, they would be left with 1 share after the reverse split that's worth twice as much. Or however many shares SoFi decides to reverse split. It could be anywhere from 2 to 10 according to their proxy statement. Again, this shouldn't affect SoFi's value as a company or how much your investment in SoFi is worth directly, but it could have some secondary effects on SoFi as an investment. As the club said in his video on SoFi, it's not a sign that things are going well for the company.
Now, when a company does a reverse stock split, it's never bullish.
And I actually agree with him, even though I hold SoFi stock. So why then would SoFi do a reverse stock split in the first place? Well, first off, SoFi isn't for sure going to perform a reverse stock split, but in a proxy statement they issued in preparation for a shareholder vote in July, the board of directors wants permission to effect a reverse stock split if necessary in the 12 months following the vote. So we as investors get to decide if we want them to have the power to do a reverse stock split if necessary. Now, the primary reason SoFi would likely want to do this has to do with institutional ownership, basically hedge funds that want to invest in SoFi. See, SoFi is currently trading at around $7.50 per share as I am filming this video. But if that price drops below $5 per share, SoFi will be considered a penny stock, which is actually a pretty big deal. Once this happens, many institutional investors like pensions or hedge funds have rules that prevent them from investing in the company at all, since it's now considered too risky to invest. This would cause large institutional money to be pulled out of SoFi, dropping the stock price further and potentially spooking retail investors. They then could start to panic sell, and pretty soon SoFi would be worth a fraction of what it was a few months ago. So by giving the board permission to combine shares of stock to keep the stock price away from that $5 threshold, it protects SoFi from this worst case scenario. But why would SoFi be worried about dropping below $5 a share? After all, that's a 33% decline from where they are right now, and the stock is already down 70% from its all-time high. Is there something management isn't telling us, or is there something even more nefarious going on with SoFi's leadership? One theory I've seen on Twitter and in YouTube comments is that Anthony Noto wants to boost the stock price artificially to get paid out extra bonuses by the company. Page 57 of that same proxy statement we looked at a second ago lays out different hurdles SoFi's stock price needs to reach for Noto to be paid out bonuses, with bonuses paid out at $25, $35, and $45 stock price targets. These collectively could be worth as much as $300 million. So the theory goes that with SoFi's stock price currently sitting a little over $7 a share, a reverse stock split where 10 shares are combined into one would put the stock price at $70, winning Noto all the bonuses. So does this theory hold water? Well, probably not. One of the reasons for having a board of directors at all is to maintain oversight over CEO compensation. And remember, this proxy vote would give power to the board of directors, not to the CEO directly. Secondly, Noto isn't the only person promised stock for performance, and I am 99% sure that if the company undergoes a reverse split, they will have language to adjust all the bonus targets upward accordingly. Otherwise, every SoFi manager who's promised list 1,000 shares for good performance will suddenly be earning 10 times more. And it's hard for me to imagine that a finance company couldn't see such an obvious issue coming. Now, maybe I'm wrong, but in that case, SoFi's leadership would need to be completely corrupt. And if I really believed that, I wouldn't be investing in the company in the first place. But okay, let's say Noto is not committing fraud. But there's still the important fact that a reverse stock split company tends to underperform the general market. Just look at GE since their reverse stock split last year, or Citigroup since their reverse split in 2011. Is SoFi setting itself up to follow the same path as these companies and underperform going forward? Well, there's two different ideas we need to separate out here. There's whether or not SoFi's management should undertake a reverse stock split, and then there's also whether or not a reverse stock split is a bearish signal for the stock. Now, starting with the second, I think it's hard to argue that a reverse stock split is a good sign. You don't combine shares in the company if the company is already doing well. I think that the reason that companies who undergo reverse stock splits tend to underperform is because you only need a reverse stock split if your share price is already declining. But that is very different from saying SoFi should actively avoid doing a reverse stock split. Here's a metaphor. It's like saying that having brain surgery is not a sign of good health. Well, I agree with that. If you need brain surgery, you probably have some sort of serious medical problem. But saying that having brain surgery is a sign of bad health is totally different from saying a person should not have brain surgery. Because what if they need that surgery to survive? I don't think that SoFi is intentionally trying to screw over investors. They are acting in our best interest by saying if the worst should happen and SoFi drops below $5 per share, then give us the tools to keep this company alive. So I think that this is the right move from the board. But let's say that the worst case does happen and SoFi does go and reverse split its stock. What does that mean for our investment? Well, in the short term, there will be a few impacts. First of all, shares are going to be more expensive, which may drive away some of the smaller retail investors in the stock, which honestly could be a net benefit in removing some of the volatility from this company. Second, it may increase short interest in the stock, as this graduate study from Utah State University found that average short selling increases significantly for firms that reverse split their stock. Number three, it could cause a negative psychological association with the stock by investors who have been burned in the past by reverse stock splits, which I would actually see as an opportunity to potentially invest, since the company's fundamentals wouldn't be affected while the stock price would. And for a long-term investor like me, this could give us an opportunity to buy in while the stock price is temporarily low, in the hopes that the market in the long term values the company based on its fundamentals rather than the sentiment, which in my experience is what tends to happen. After all, AIG is up since their reverse split, and the same is true for Motorola. So far we've covered what a reverse split is and what effect it could have on the stock. But how likely are we to need a reverse split? StockGoat pointed out in his video that SoFi beat estimates last quarter and raised their guidance for the rest of 2022. So why is leadership worried about the stock price declining to below $5 per share? Well, I think that there are two main risks facing SoFi's stock price in 2022, a recession and retail investors. In SoFi's last earnings call, CEO Anthony Noto called out that their guidance for 2022 assumes we will not see a recession in 2022. Meanwhile, celebrity investor Cathie Wood is convinced we will see a recession in the next 6 to 18 months. Now, I don't claim to be able to predict the future, but there is at least a chance that we will see a recession, which could cause SoFi to completely miss its guidance for the year. This could conceivably drive its price down by the 33% needed to make it a penny stock. Now, is this likely? I don't think so. But it's SoFi's leadership's job to plan for the best and prepare for the worst, and a recession is a real possibility, especially considering SoFi's current reliance on stock-based compensation, which currently equals 30% of SoFi's overall revenue. If SoFi's lending segment, for example, gets hit hard enough by the recession, that percentage could go even higher as total revenue growth slows down, putting downward pressure on SoFi's stock price. The other big risk facing SoFi's stock is retail investors. At different points, SoFi has been lumped in with meme stocks whose price is based more on public sentiment and hype than company fundamentals. Communities such as Wall Street Bets have made millionaires off of companies like GameStop, but they can also drive prices down in stocks that fall out of favor, and that sentiment can shift on a dime. Just look at SoFi's social media sentiment, which has seen an 84% drop in posts on Wall Street Bets and a 50% drop in media attention over the past few months. TipRanks shows investor sentiment is net negative on the stock today, which is pretty far away from the euphoric SPAC days of Chamath Palihapitiya. There is a lot of retail interest in this stock, and a lot of that interest is from people who are not doing serious research. It's people who have a very short time horizon for their investments, which can make their trades short-sighted. Now, if you're watching this far in the video, that probably isn't you, but in my personal experience, every time I've taken a short-term view on a stock, I've gotten burned. Every single time. Even the few times where I made a little money just riding the stock up a little bit, I would have made way more money by simply holding the stock as it rose. Now, I'm not saying that trading and investing based on the news cycle can't work, it's just never worked for me. So at this time, I am not selling SoFi based on the possibility of a reverse stock split. And as far as SoFi's upcoming shareholder vote on July 1st, realistically, I won't submit a vote since it wouldn't really make a difference with how many shares I have. But if I were to vote, I would vote to give the board the power that they're asking for. So I was wrong about SoFi's stock split vote not being a big deal, and I really appreciate all the comments that called me out on that video for not mentioning it. The fact is that anything that's getting people scared or people are just curious to know about the company is relevant to the company, whether or not I think it should affect the stock price. I also really appreciate all the little nuggets of knowledge that have been shared in the comments section, and I think that kind of sharing of knowledge is super helpful to all of us, since I know they help me try to make this channel better over time. Now, the title of this video was I was wrong about SoFi, which is there to grab your attention, but on a serious note, I know that going forward I'm going to make mistakes. I promise that I will, but I also promise that I'm going to fix those mistakes when they happen. When I look back at my channel from a year ago and all the videos I was putting out then, I think that the quality of the channel has improved dramatically since then, but there's still a long way to go. And as long as you keep watching and commenting and engaging as a community, I'm not going to stop until I can make every video better than the last one. That's really all I can offer, and I hope that's enough. Also, shout out to the club. I know that I kind of disagreed with some of what he said in this video, but I think he has a really good channel overall. Don't forget to like and subscribe, and I'll see you next time.